The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. Without objection, all members will have 5 legislative days within which to submit extraneous material to the chair for inclusion in the record. I want to thank our witnesses, our excellent panel today for being here. I now recognize myself for 4 minutes to give an opening statement. Today's hearing is entitled Digital Dollar Dilemma: The Implications of a Central Bank Digital Currency and Private Sector Alternatives. We're here to better understand what central bank digital currencies are and the concept of digital money, to compare CBDCs to privately issued payment stablecoins, and how design choices would impact areas like consumer privacy, banks of all sizes, and monetary policy. I'd like for members to hear from our witnesses today, not only about Communist China's proposed digital yuan, but what steps the United Kingdom and the European Union have taken and why. So far, the conversation is focused on the Federal Reserve's legal authority to issue a CBDC. Look, the Constitution is clear. Only Congress has the authority to coin money and regulate the value of such money. And we've heard the same from Fed officials right before this committee, and most recently from Vice Chair for Supervision, Michael Barr, who last week told an audience in Philadelphia, and I quote, "The Federal Reserve would only proceed with the issuance of a CBDC with clear support from the executive branch and authorizing legislation from Congress." The Biden Department of Justice agrees, saying, quote, "There would be substantial legal risk to issuing a CBDC without such legislation." So let me be unequivocally clear here for this audience. There is no support for a CBDC in Congress except from those on the fringes who think somehow a CBDC might be an amazing solution to many unstated global problems. Several members, Mr. Emmer, Mr. Mooney, Mr. Auchincloss, and I have introduced bills stating that the Federal Reserve does not have the authority to issue a U.S. CBDC. I particularly want to say thank you to Mr. Auchincloss, Mr. Torres, and Mr. Nickel for their work on our bill and demonstrating that this isn't a controversial or partisan point of view. Let me be clear. While a retail Federal Reserve-issued CBDC is not in the cards, there are many significant areas for improvement in our U.S. payment system. We need less complaining and more facts and progress. Payments can be modernized by modifying the existing system infrastructure through innovations led by the private sector. Some modifications have yet to be implemented, like expanding the days and hours of the Fed wholesale payment services like the National Settlement Service or FedWire. These developments would provide for instant payments for individuals and businesses through their financial institution. It's not okay that the Fed still hasn't finished this work even a decade later with no clear timetable for its completion. However, other improvements are already underway. The RTP network has been around since 2017, while the FedNow service was recently launched in July. Turning to innovations in blockchain payment rails, our committee marked up Clarity for Payment Stablecoin Act in our committee during July, which establishes a federal regime for payment stablecoins with strict reserve and capital requirements, disclosures, and attestations to protect consumers. I want this hearing to explore whether a U.S. CBDC is the most efficient and effective means to address payment inefficiencies, or if in fact private sector alternatives and improvements to our existing payment system and infrastructure can better provide more immediate solutions. I look forward to hearing our witnesses' perspectives. I thank all my colleagues on both sides of the aisle for their dedication to thoughtfully explore this issue. Working together, we can modernize the U.S. payment system. The chair now recognizes the ranking member for the Subcommittee on Digital Assets, Financial Technology, and Inclusion, the gentleman from Massachusetts, Mr. Lynch, for 4 minutes for an opening statement.
Thank you, Mr. Chairman, for holding this hearing on such an important topic. As the former chair of the Task Force on Financial Technology, I held a handful of hearings on central bank digital currencies during my tenure. We heard from experts who discussed the potential ways in which a government-issued digital dollar could be designed to promote financial inclusion and protect privacy while streamlining our payment system and preventing fraud. I'm eager to continue these discussions, if that is allowed, and I hope that we can do so in a productive way. I worry about some of the recent false narratives and fear-mongering, much of which has been fueled by the crypto industry itself. That fear-mongering around a CBDC being weaponized as a tool for government surveillance or control. It's important to correct some of the inaccurate and misleading claims that could lead us to shut down innovative policy approaches before we have even begun a meaningful discussion. A CBDC is just one type of publicly issued digital dollar and would be issued, backed, and regulated by the Federal Reserve and have the full faith and backing of the U.S. government. This could serve as an alternative to existing forms of payments and have a benefit including instant payment settlement, provide a medium for cross-border transactions, and foster greater financial inclusion. More than 130 countries have begun to explore their own government-backed digital currencies. China, Russia, Saudi Arabia, and India have already commenced pilot programs, and a digital euro pilot could be launched as early as 2028. Meanwhile, the U.S. remains far behind amid increasing and blatant information about features of digital currency. While concerns about data privacy and government surveillance are real, especially in countries that do not respect human rights and privacy, a CBDC does not have to be designed that way. We could employ an architecture that would protect personal data while including anti-money laundering and terrorist financing features. It is counterintuitive that my colleagues should be raising concerns about data privacy while thousands of private companies, domestic and foreign, are surveilling, aggregating, and selling consumer data each and every day. As policymakers, we should be asking questions about how a digital dollar could be designed to maximize privacy and prevent exploitation of personal data. To dive further today, I'm announcing and inviting my colleagues to join the Congressional Digital Dollar Caucus. This forum will educate members on critical issues relating to the development, design, and potential implementation of a government-issued digital dollar. I plan to invite innovators, technologists, academics, and other experts to share their findings and development. I hope my colleagues will join me in this exploration. I should make it clear that I do share the concerns with some of my colleagues about the need for digital currencies that respect privacy and anonymity. The use of anonymous cash has plummeted, and more of our transactions are occurring online and under surveillance, tracked and aggregated by financial services companies. Indeed, China has turned that fact into a tool of full-spectrum surveillance of its citizens. This is why I've introduced the eCash Act. This bill directs the Treasury to design and pilot a digital version of cash and would complement the Fed-issued CBDC. It would allow individuals to make instant peer-to-peer payments with no consumer data or transaction tracking and without the use of a bank account. This bill represents one of the many design choices of a digital dollar. In closing, I hope my colleagues will join me in this exploration rather than moving legislation that bans the Fed from issuing a CBDC or even goes so far as to prevent research or pilot programs. I call on my colleagues to thoughtfully engage on this topic and do not succumb to industry-driven narratives that prevent the U.S. from moving forward. Thank you, Mr. Chairman, and I yield back.
I thank the gentleman from Massachusetts, and now let me recognize the distinguished Majority Whip, Mr. Emmer from Minnesota, for 1 minute.
Chairman Hill, I want to thank you. This is an important hearing that you're holding today, and I appreciate it. Open, permissionless, and private. What do I mean by this? In our digital economy, all transactions are intermediated by banks, governments, or big tech. We must develop digital tools that function like cash. These digital assets must be open and freely accessible to all, without requiring permission from the government or anyone else, and private, safeguarding the user's identity. These qualities are fundamental to a free society, and unfortunately, the administrative state would rather have a cashless economy run on a central bank digital currency, a tool the communists have, than to work to maintain our American values in the digital age. The need to protect Americans' right to financial privacy is an all-time high. That's why I introduced the CBDC Anti-Surveillance State Act with over 50 of my colleagues. This bill prevents unelected bureaucrats from creating a tool for financial surveillance. If not open, permissionless, and private, like cash, a CBDC is nothing more than a CCP-style surveillance tool that will oppress the American way of life, and we're not going to allow that to happen. And Mr. Chair, I'd like to submit for the record my December 1st letter to the Susan Collins at the Federal Reserve Bank of Boston about their shady CBDC pilot they've been running.
Without objection, and the gentleman's time has expired. With that, we want to welcome the testimony of our panel. Dr. Norman Michel is the Vice President and Director of the Center for Monetary and Financial Alternatives at the Cato Institute. Ms. Paige Paradon is the Senior Vice President and Senior Associate General at the Bank Policy Institute. Mr. Yuval Ruiz is the co-founder and CEO of Digital Asset, an enterprise blockchain provider seeking to provide programmable smart contracts to traditional financial institutions. Professor Christina Skinner is an associate professor at the Wharton School at the University of Pennsylvania, where she focuses on central banks and fiscal authorities. And Mr. Raul Carrillo is an academic fellow and lecturer at the Columbia Law School, where he analyzes financial regulation, technology, and innovation. We thank each of you for taking time to be with us today. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made a part of the full record. And we're going to start with Dr. Michel. You're now recognized for 5 minutes.
Good afternoon, Chairman Hill, Ranking Member Lynch, members of the committee. Thank you for the opportunity today to testify. I'm Norbert Michel, Vice President Director, the Center for Monetary and Financial Alternatives at the Cato Institute. The views I express in this testimony are my own and should not be construed as representing any official position of the Cato Institute. In my testimony, I argue that the United States should not launch a central bank digital currency, a CBDC. Advocates for a CBDC tout many potential benefits, but there's nothing unique about the technology that would provide those supposed benefits. Frequently, advocates completely ignore private sector innovations as well as the potential risks a CBDC poses. Regardless of the possible design choices, such as whether a CBDC is direct or, as the Fed calls it, intermediated, these risks far outweigh any potential benefits because a CBDC is not, quote, just another form of money. A CBDC in any form would be a direct liability of the central government, a digital tether to its citizens, such that it would radically alter the existing public-private relationship that already exists in our monetary arrangement. There are many myths surrounding CBDCs, and I will use my time to discuss what I consider the 3 most important. First, issuing a CBDC would not help preserve the status of the United States dollar. It would likely damage it. Proponents argue that because China has launched a CBDC, the United States must keep up by launching its own. Others make the narrower claim that the U.S. must launch a CBDC to keep up with broader technological changes in the payment sector. But anyone who chooses to do so can transact digitally in U.S. dollars right now. A CBDC does not take us from a world with 0 or few digital transactions to one filled with digital transactions. Moreover, the dollar's renowned status is owed to the strength of the American economy and its legal protections for private citizens relative to many other countries. Unlike in many other places, Americans do not have to live in constant fear that the government will take their money. However, if the U.S. creates a CBDC, anyone who wants to use the dollar would lose a layer of protection from that type of government abuse. The second myth is that a CBDC would expand financial inclusion by providing a new source of financial services for America's unbanked and underbanked populations. Again, though, this is not a technological problem. In other words, the CBDC itself does not accomplish this goal. The private sector already enables us to transact digitally, and it has been steadily shrinking the number of Americans without financial services for years. We also know, because the FDIC asked them, that unbanked and underbanked Americans primarily are in that situation because either they don't have enough money to have an account or they don't want to give their personal information to a bank or the government. And what should be obvious is that a lack of sufficient income is a much broader economic problem than a CBDC or financial service technology. While some proponents argue that a CBDC lowers the cost of providing financial services, that's true only if the government subsidizes those costs or chooses to waive the same level of regulatory scrutiny it requires of private firms. And that level of scrutiny, it turns out, is more than just a costly mandate that the government has placed on private firms. It's also the one that causes those unbanked Americans to say they don't trust banks. It's also the same one that requires people to hand over their personal information to private companies and, as a result, potentially to the government. If the government removes that mandate for all financial service providers, there would be no cost advantage to a CBDC. That brings me to my last myth, the idea that a CBDC could somehow enhance financial privacy. Currently, Americans are forced to hand over personal information to financial institutions. Those institutions are required to track transactions, and the government can access that information without a warrant. The Fourth Amendment is supposed to protect Americans from the government gaining access to this kind of information unless they show probable cause and obtain a warrant. But it no longer protects Americans when it comes to financial information. And the only buffer left is that the government must go through the financial institution to obtain that information. Introducing a CBDC would remove this last layer of protection. It would place all financial transactions either in a government database or leave them a keystroke away. The United States should not launch a CBDC or provide direct wallets or accounts. Thank you for your consideration, and I'm happy to answer any questions that you may have.
Thank you, Dr. Michelle. Ms. Paradon, you're now recognized for 5 minutes to give your oral remarks.
Thank you, Chairman Hill, Ranking Member Lynch, and honorable members of the subcommittee. Thank you for inviting me to testify. My name is Paige Paradon, and I am a Senior Vice President and Senior Associate General Counsel at the Bank Policy Institute, a nonpartisan policy, research, and advocacy organization representing banks with over $100 billion in U.S. assets. Technological innovation over the last several years has led to the increased speed of payments, clearing, and settlement, and new forms of digital money. In part, due to concerns about this innovation, central banks have been studying and exploring the potential benefits of a central bank digital currency, CBDC, a form of digital money that is a direct liability of the central bank. Fortunately, the Federal Reserve Board has recognized that as both a legal and policy matter, Congress should decide whether the United States should have a central bank digital currency. On balance, we believe that at this point, there is little evidence that a CBDC would bring measurable benefits to the U.S. economy or consumers. Furthermore, a CBDC could upend the commercial banking system and create financial instability. A CBDC can take one of two general forms: a wholesale CBDC, which would be used only by financial intermediaries, and a retail CBDC, which could be used by consumers and businesses. To date, most research and attention has been focused on a retail intermediated account-based model in which consumers' CBDCs would be held in an account at a bank or another financial intermediary. Like an asset held in custody, the CBDC could not be used by the bank to make loans in the way that dollar deposits are used today. Any transfer of a dollar deposit from a bank to a CBDC is a dollar unavailable for lending to businesses or consumers. By attracting deposits away from banks, a CBDC likely would undermine the commercial banking system in the United States and severely constrict the availability and increase the cost of credit to the economy. Many of the purported benefits of a CBDC are uncertain and furthermore are achievable through alternative, less risky means. For example, some have argued that a CBDC is necessary to increase payments efficiency and foster financial inclusion. However, in the United States, banks have led numerous efforts to improve the speed and security of payments, reduce the cost of financial products and services, and advance financial inclusion. For example, in 2017, the Clearinghouse launched RTP, a real-time payments network, which currently reaches 65% of U.S. demand deposit accounts. Zelle is another example of bank-led innovation, a bank-owned peer-to-peer payment service through which transferred funds are available almost immediately. In addition, banks stand ready to meet the demand for a blockchain-based cash equivalent instrument within the safety of the regulatory perimeter, such as by issuing deposit tokens. With respect to financial inclusion, a review of the reasons why certain individuals are unbanked makes it clear that a CBDC would be unlikely to meaningfully increase financial inclusion. For example, FDIC data reveals that many respondents are unbanked because of privacy concerns. An intermediated CBDC is unlikely to mitigate those concerns, given that it would presumably come with the same know your customer requirements that currently apply to banks. Furthermore, to help foster inclusion, banks are expanding access to safe and affordable financial services, such as low-cost banking accounts, including through the Bank On National program, which has the goal of ensuring that everyone has access to a low-cost bank account. There are over 375 Bank On nationally certified accounts, representing over 60% of the domestic deposit market. Ultimately, because a CBDC could undermine the commercial banking system and threaten financial stability, and because the purported benefits of a CBDC can be achieved through less harmful means, we agree with the Federal Reserve that further steps toward developing a CBDC should only be taken if research points to benefits for households, businesses, and the economy overall that exceed the downside risks and indicates that CBDC is superior to alternative methods, and only with the support of the executive branch and with legislative authorization. Thank you again for the opportunity to testify. I look forward to your questions.
Thank you so much, and now we'll go to Mr. Ruse. You're now recognized for 5 minutes to give your oral presentation.
Thank you, Chairman Hill, Ranking Member Lynch, and other committee members. My name is Yuval Ruse. I'm the co-founder and CEO of Digital Asset. As this committee deliberates on how best to bring the dollar into a digital era, I'm here to make two requests. First, that Congress ensures that any digitally represented dollar, whether a stable coin or a CBDC, lives within our constitutional framework. Americans using any digitally represented dollar should have the assurance that their privacy rights are protected under the Fourth Amendment framework. And second, that Congress works closely with the private sector and leverages technology already built and proven to serve the rails for any digitally represented dollar. Any solution that ignores private sector innovation risks technological stagnation and will ultimately undermine our global competitiveness. I helped found Digital Asset in 2014. Digital Asset is at the forefront of modernizing the infrastructure of financial system with our privacy-focused blockchain technology. For 9 years, we have worked hard to carefully and responsibly innovate to solve real problems in financial services. Today, our clients are using our privacy-focused DAML application platform and Canton blockchain protocol to reduce the time to issue bonds, stocks, and other financial instruments from days to seconds, ultimately reducing the settlement risk and increasing efficiency. One client is using our technology to process over $1 trillion of tokenized repo agreements per month. And our technology was recently used in a pilot project with the New York Federal Reserve's Innovation Center to demonstrate how blockchain technology can modernize the infrastructure for global dollar-based settlements. Importantly, this pilot project tested a shared ledger within the existing two-tier banking system to more efficiently record the movements of Federal Reserve money that occurs between banks on a daily basis. We recently announced, along with 29 market participants, the launch of the Canton Network to help connect institutions and move value globally. Our success is in no small part due to the fact that our technology is built with privacy at its core, making our technology well-suited for financial services. I'm here today because as we embark upon a new digital era in finance, I believe the global financial competitiveness of the United States, including the dollar's position as the world reserve currency, is at stake. This is a critical national security issue that demands innovation led by the private sector. But private sector innovation alone is not sufficient. As we've seen with the invention of the internet, without a proper policy framework and absent a strong partnership between the public and private sector, private sector initiatives may displace activities properly considered public goods, specifically money, that are due the protection offered by our Constitution. We expect our financial transactions to be afforded the privacy protections of the Fourth Amendment, and this should not change as payments become more digital. History has shown that technology is inseparable from finance, and today we stand at yet another technological inflection point for financial system, blockchain technology. As our successful client deployments demonstrate, blockchain technology, when built around configurable privacy, can provide the financial system with increased efficiency and reduced risk. It eliminates the need for maintaining multiple copies of the same information and allow value to be represented digitally. Leveraging blockchain technology to modernize financial infrastructure is critical to ensuring our continued global financial competitiveness and the dollar's status as the world's reserve currency. It is the rails on which digital value will be transferred. Of course, innovation alone is not sufficient for the United States to maintain its global competitiveness. But our role today as a global financial leader, with the dollar as the world's reserve currency, does require innovation. There is nothing inherent or inevitable about the inefficiencies in today's financial system. As other countries' financial systems eliminate these inefficiencies through blockchain technology, the United States risks being left behind and losing our leadership position. A global economic order aligned with our values is in our national interest. We have two critical advantages that can help us maintain our leadership position: vibrant private sector innovation and the rule of law enshrined in our Constitution and protected by its system of checks and balances. And our advantages are strongest when wielded together. While private sector innovation is important and is the engine that drives our economy, in an area as critical as finance, innovation needs to occur within a deliberate policy framework to ensure that innovation does not outrun or undermine our values and national interest. Thank you.
Thank you, Mr. Roos. Now we'll turn to Professor Skinner. You're recognized for 5 minutes for your oral presentation.
Thank you, Subcommittee Chair Hill, Ranking Member Lynch, members of the subcommittee. Thank you again for the opportunity to testify on this important issue of CBDC in the United States. Although a CBDC remains hypothetical today, assessing the costs and benefits of CBDC is crucial to your ability to establish the appropriate lane markers for the Federal Reserve when it comes to money and payments. After all, Article 1 of the U.S. Constitution gives Congress the exclusive power to decide what money is. And although it's constitutionally permissible for Congress to delegate some monetary authority in certain respects, it's important that Congress not abdicate that authority by ceding too much discretion to pilot or develop a CBDC. So in my remarks today, I'd like to highlight 3 predictive points that I elaborate in further detail in my written testimony. First, introducing CBDC would change the people's relationship with the state, and by that I mean the government. Second, a CBDC would certainly change the relationship with the central bank. It could empower the central bank while at the same time weakening its independence. And third, even though CBDC is highly popular among many of the world's leading central banks, there is no discernible reason for the United States to move toward a CBDC right now. So privacy rights are the clearest place to start. Today, individuals can enjoy comprehensive privacy in their payments transactions by using cash. Now, although most central banks have suggested that CBDC is not going to replace cash, that near-term promise can't be guaranteed over the longer term. And the insinuation that CBDC is necessary or inevitable seems motivated by a view that cash will eventually become obsolete. But because central banks don't have the technology presently to offer cash-like privacy, a digital currency, unless it's radically redesigned, will bring with it the ability for the state to monitor or surveil its citizens' payments activity. So to turn to my second point, I'd like to focus on the impact of a CBDC on the Federal Reserve. Certainly, since 2010, the power and authority of the Fed has grown considerably, and Congress's responsibility to oversee the Fed requires it to understand how a CBDC could further empower the central bank, but also how it might weaken it. On the one hand, CBDC could result in a larger central bank balance sheet. Issuing CBDC would increase the liability side of the Fed's balance sheet if the total of bank reserves, repos, and cash balances largely remained unchanged. So if the liabilities with CBDC increase, so too must the Fed's assets. The Fed could buy more Treasury securities to match CBDC, but that could possibly invite pressure on the Fed to issue more CBDCs to in turn absorb more government debt. And overall, that dynamic could further erode the limited fiscal discipline that we have remaining. A CBDC could also affect the Fed's independence in the way that it would establish a direct relationship between the central bank and the real economy for the first time in history. One result of that relationship would almost certainly be the further erosion of the line between monetary and fiscal policy. Once central banks begin to issue liabilities directly to the people, it'll become much more difficult for the central bank to justify the provision of liquidity to banks in the financial system as opposed to households, especially during a crisis. And effectively, this could open the door to political pressure on the Fed to provide liquidity assistance to households during turbulent economic times. But these sorts of household-level interventions would radically transform the central bank and its purpose and role within society. For my third and final point, I'd like to briefly address the international dynamic that's currently in play. Leading central banks around the world, including the European Union, the European Central Bank, and the Bank of England, have much more strongly indicated their desire and intention to move toward a CBDC than the Federal Reserve has. But there's really no need to hurry for fear of missing out. It's important to recognize in this context that sometimes the emperor might not be wearing any clothes. The dollar that's used by households and businesses domestically and internationally is already digital. In fact, one is hard-pressed to find a compelling problem that CBDC solves. It does not inherently improve financial inclusion unless it's paired with accounts for all citizens, which the central bank itself has already recognized as infeasible. Nor does CBDC increase financial stability, given the extent to which we can expect it to disintermediate the banking sector. And while CBDC might expand the monetary policy toolkit, using remuneration on CBDC as a monetary policy instrument would invite the central bank to make socially contentious judgments. Finally, in closing, I'd like to add my voice to the chorus of those who have emphasized that the dollar's reserve currency status, undoubtedly a tremendous asset in the United States, does not turn on whether it's a CBDC. Our best approach is to preserve the global status of the dollar through our commitment to the rule of law, democratic institutions, and free market principles of innovation and well-tailored regulation.
Thank you, Professor. Mr. Carrillo, you are recognized for 5 minutes for your oral presentation. I might check your mic, sir.
Good afternoon, Chair Hill, Ranking Member Lynch, Committee Ranking Member Waters, distinguished members of the subcommittee. Thank you for inviting me to testify. My scholarship focuses on financial technology, especially digital privacy and sound data governance. My research also draws on my experience as a regulator, a legal services attorney, and a policy counsel. It also draws on my experience in my upbringing in the U.S.-Mexico borderlands, a region under constant surveillance by government in partnership with Silicon Valley. Today, I support the call for a digital dollar system, including CBDC, Fed accounts, and eCash. I strongly believe that we can actually build a digital dollar system that respects our civil rights and freedoms and is safe for everyone to use. To frame our conversation more constructively, I will focus on two critical, faulty assumptions that dominate digital dollar discourse, including this hearing today. These faulty assumptions limit our collective capacity for innovation. The first faulty assumption is a matter of design. When we narrow the digital dollar to CBDC and the conversation to the Fed, we do a disservice to the public. This is incredibly unhelpful, especially when we discuss the digital dollar at the retail level. At a minimum, our conversation should include a discussion of the Treasury and its many bureaus, including the Mint, Bureau of Engraving and Printing, Bureau of Fiscal Service, and the Secret Service, who are involved in the deployment of financial technology every day. Second, when discussing privacy, the digital dollar system and CBDC should be compared to the existing systems that we are already using. As has been pointed out, the private sector does not protect data security or data privacy sufficiently. Crude opposition to CBDC based on surveillance grounds with no comparison to a real baseline is blinkered and leads us to throw the baby out with the bathwater. Just 6 years ago, last Thursday, Equifax revealed it had been breached, granting hackers access to the personal sensitive information of nearly every adult in the United States, including those without credit scores. The fintech world of more sophisticated data brokers and super apps engages in data maximization as a business model and embraces unnecessary complexity that undermines data security. Of course, the Fed is also engaged in its data-intensive financial surveillance, often in partnership with big tech and fintech. That part has been left out of our conversation today. Here, the precise problem is that the doctrine and technological platforms that the government uses evade data collection constraints by acquiring data from private sector entities that are not ceasing to collect that data, whether their ledgers are centralized or decentralized. The major financial surveillance threat in the United States is not in the public or private sector per se, but in both, and more importantly, in the links between them. The digital dollar system presents a unique opportunity, I think, to actually build financial privacy and security in this country through public infrastructure that would benefit everyone. But the digital dollar system will not do so if we build it like the Chinese system, and it will not do so if we allow third-party access to retail payments data beyond what is necessary to effectuate payments, as the private sector does today. Indeed, the only way to evolve beyond the surveillance status quo is to establish a direct digital dollar interface with consumers where the Fourth Amendment and other protections may actually apply. If we truly care about privacy, we should treat the banking and blockchain industry appeals to partnership as suspect based on legal and technological grounds alone. We can build a retail CBDC and Fed account system with superior protections compared to what exists now and superior protections to the systems that are being built around the world currently. So today, I also advocate for the inclusion of digital cash as detailed in the Electronic Cash and Hardware Security and Secured Hardware Act, the eCash Act, reintroduced by Representative Lynch today. eCash devices available on a smart card or a phone card would serve as digital counterparts to cold, hard American cash. These devices would not make payments over the internet. Instead, they would store Treasury-issued digital dollars on card hardware to enable everyday small dollar transactions for everyday people. These transactions would be subject to the BSA AML regime, and as a boon to law enforcement, we can set privacy-sensitive security controls and caps on transactions and usage. However, the cards would in no instance be capable of generating data that companies and agencies can abuse. We preserve a place for privacy within public infrastructure. The eCash Act harkens back to the past, to the days when President Lincoln established the banking and cash system that we still use today, and it also harkens to an exciting, inclusive, safe digital future. Thank you.
I thank the gentleman. Before we go to member questions, a note of housekeeping. This hearing will recess for the 3 p.m. vote series and immediately resume after votes. I now recognize myself for 5 minutes for questions. Appreciate the panel and the engagement and the good testimony today. And sometimes what's lost in this conversation about central bank digital currencies is that ultimately, for this conversation, it's about a payments issue. If you look at countries around the world that have started piloting or launched their own CBDCs, it's loaded on people's mobile wallets and used to pay for things at a checkout counter. It's a big reason why some of us that oppose a U.S. CBDC warn, for example, that an unchecked government could monitor your purchases at the gun store, flag you as a threat, cut you off your access to your bank accounts, even though you haven't done anything illegal. If you think Operation Choke Point was bad, let that sink in. Payment and transaction data can tell you a lot about somebody. That's why CFPB's Rule 1033 about the scope of the rule and whether it should be extended to Reg E and Reg Z accounts or beyond is so important. So in terms of payments, I'd like to have a good discussion about how Congress should be thinking about CBDCs in a world where payment stablecoins already exist with a total market capitalization of between $100 and $200 billion, and they're already here, they're already functioning. They aren't really being used by retail holders to pay for things like Starbucks coffee, but if stablecoins are issued under a strong federal framework, like the one we envision in our Clarity for Payment Stablecoins Act, they certainly could be. So Mr. Roos, in your view, could a U.S. CBDC and payment stablecoins coexist and be integrated and interoperable with one another, and should they?
Thank you, Chairman Hill, for the question. First of all, I do think that any technological solution that the U.S. would want to carry forward is possible. I think that, as I stated in my opening remarks, I think that when it comes to money, trust is a very big component, and therefore privacy is going to be a very critical component of it. I think that it's important to understand that our perspective is that the usage of blockchain technology is all about reducing reconciliation. And I think that it's important that the government, in order to have trust in its payment system, whether it's by the private sector or by the government, has our privacy protected. You stated that stablecoins exist today. That is true. And I do think that there are technologies that can even improve our trust in stablecoins. As we know today, there are companies out there that know how to look at public permissionless blockchains and harvest information. And therefore, I think that we should, as introduced by the bill around stablecoins, create a framework that helps the government also set the rules for stablecoins.
Thank you. Appreciate that. Mr. Michel, do you think that they obviate the need for one another? Do you think payment stablecoins should be interoperable with a CBDC, or do you think actually stablecoins obviate the need for a CBDC in this blockchain payment space?
The latter. They obviate the need for them. I do not believe any private company is going to be able to compete with the government, and that's a broader rule, and it applies here as well.
Yeah, thank you. Ms. Peridot, your testimony, appreciate it very much. You talked about upending the banking system, which is something that doesn't get a lot of conversation on this topic, where these CBDCs would actually be a liability of the central bank and not of the banking system, and thereby taking out the source of funding for all of America's lending. Could you expand on that, please?
Sure. A CBDC, because it would be a direct liability of the central bank, it would be perceived as the ultimate safe asset. So from that perspective, particularly during times of economic stress, it could attract depositors to pull their money out of the banking system to flee or run to a CBDC if there was perceived concern about the banking system or the financial system overall. So every dollar that currently resides in a bank account can be deployed for useful purposes in the economy, primarily through lending. Every dollar that is pulled out and from the banking system and put into a CBDC is one less dollar that could be put to good economic use. And that is why we have a fundamental concern with a retail CBDC, given the flight to quality risks.
Thank you for that. I'd like, in the time remaining, Mr. Roos and Professor Skinner, if you would write written answer to my question on your views of what other countries that are issuing a CBDC, what you see the features and technology or the pros and cons there. If you do that in writing for me, I'd appreciate it. It's now my pleasure to call on the ranking member of the full committee, the distinguished gentlewoman from Los Angeles, Mrs. Waters, for her questions. 5 minutes.
Thank you very much. I'd like to direct my question to Mr. Carrillo. 130 countries representing 98% of the global economy are now exploring digital versions of their currencies, including the United States. Almost half of these countries are in advanced development, pilot, or launch stages of their CBDCs. Can you discuss how CBDCs may shape the future global financial landscape? What would it mean for the United States if we instead chose to stay on the sidelines of this race?
Thank you very much for the question, Representative Waters. My opinion is that it is incumbent upon the United States to provide leadership with respect to an inevitable process that is going to occur across the world. It is clear that we're all moving to digital fiat currency. The question is what sort of protections are going to attend digital fiat currency. If we don't get this right now, the rest of the world is going to move on, likely with systems in some places that are less protective of privacy and data security than our own. I think that the rhetoric around an arms race has been particularly unhelpful. In fact, there is opportunity for collaboration here, not with the totalitarian systems, but with folks who are building digital fiat currency, especially in developing areas where there is a need for offline access. What we learn from those countries could be particularly helpful with respect to our own development in communities of color and maintaining privacy, security, and civil rights. So again, I think it is the United States' job as reserve currency leader to lead the way here with respect to civil rights and our freedoms. Thank you.
Thank you very much. If I could follow up for just a moment. There are differences of opinion, on this committee about whether or not we move in that direction. In addition to what you have just shared with us about what is happening around the world and with other countries, is there anything else that you can add to it that would show us at an advantage if, in fact, we moved to develop the CDBCs?
Yes, absolutely, Representative Waters, thank you. And I'm happy to provide detailed written answers to these on this topic as well, but I'll highlight for now something that has been, I think, a common thread throughout the testimonies of myself and my fellow witnesses here, which is that this is a space where the future of money is being defined in part by competition. I believe I just heard that CBDCs would obviate the necessity of stablecoins. In my opinion, given the volatility and the recent collapses in the cryptocurrency industry, perhaps regulating the stablecoins better with a little competition is quite a good thing. Beyond that, I would say that I hear a lot of concern across the political spectrum in this committee about the power of Silicon Valley, and if you do not create an alternative to the corporate systems that collect data or promise to protect it and then collect it en masse, which is even worse and common in the blockchain industry, then what is going to happen is that Silicon Valley is going to win. And frankly, I don't think anybody here wants that, but in order to preserve the space that we have for public money and not make it a big tech enterprise, we in fact have to move forward with digital fiat currency.
Thank you very much. I yield back.
Thank you, Mrs. Waters. The gentleman from Ohio, the Vice Chairman of the Digital Asset Subcommittee and the Chairman of the Housing and Insurance Committee, Mr. Davidson, is recognized for 5 minutes.
I thank the chairman, frankly, for having this meeting. I think perhaps the biggest existential threat to Western civilization is a wrongly structured system of money. Sound money serves as a store of value, a stable store of value, and an efficient means of exchange. One of the key characteristics of sound money is that it facilitates permissionless peer-to-peer transactions, like cash. Currently, of the 100+ countries developing a central bank digital currency, none of them are developing a permissionless system. Every one of them is developing a permissioned system, including the United States Federal Reserve. So when we talk about permissions, we can kind of get something from that from the Federal Reserve's own report of that. They said in their report that it should be privacy protected, intermediated, widely transferable, and identity verified. Mr. Michel, Dr. Skinner, Professor Skinner, in your view, is it possible to be both privacy protected and identity verified?
No, in my view, it's not. Once the information is in the system, it's in a system, and somebody's going to get it, and it's going to get out. I just quickly really want to say, I'm very happy to hear everybody here on the panel is pro Fourth Amendment. The problem, of course, as you know, is that the Bank Secrecy Act and the anti-money laundering regime runs right over the Fourth Amendment. So that's what needs to be fixed.
It's already a problem in third-party hands, but this wouldn't even be in third-party hands. But, Professor Skinner, what's your view?
My view is no, that that's not possible right now, and central banks have essentially admitted as much. And to the extent such technology is or could be under development, it's extremely immature. And I think the point to emphasize here is that inherently there will be a trade-off to the extent central banks create CBDC between identity verification and privacy. And more than likely, central banks will always choose identity verification because they will never feel comfortable sacrificing the national security goals that they see as accompanying robust identity verification.
Yeah, I don't think they can conceive of a different architecture. So fundamentally, I think a lot of people don't understand the difference between Bitcoin, for example, maybe the most widely known digital asset, and a central bank digital currency. Bitcoin is permissionless, peer-to-peer. The whole computing architecture is different. If you add zero-knowledge proofs to that, that's a different thing, but it is not identity verified. It's also not intermediated in the same way. So, Mr. Roos, what's your take on this?
I think that introducing requirements that requires identification and then privacy do introduce challenges. I think that you mentioned, or it was mentioned, the Bank Secrecy Act. At the end of the day, those type of acts create the same similar conflicts. I think technology is capable of introducing digital money that has full privacy, but I think that that has to be developed with a very clear policy that allows for public-private permissionless money.
Yeah, in fact, digital money that is private is available today. It's just not sponsored by a government anywhere. And governments generally, they want to know what you do, they want to know what you think, and as someone famously said recently, I wish I could just wake up and it not be true, but it is. And unfortunately, when you look at the money, it is being undermined. I think you've highlighted some other ways that it is, but when you look at the power that's possible with a centrally managed, centrally controlled, intermediated central bank digital currency, China is perhaps the epitome of it. Now, they don't have a Bill of Rights, they don't have civil liberties there, but they do have humans. And when humans have access to power, they tend to do it. I've referred to a central bank digital currency for the Lord of the Rings fans as the one ring to rule them all. And in my view, we ought to cast it into the fire and destroy it. In fact, our office is working on a bill to actually criminalize designing, developing, building, establishing a central bank digital currency. And why is that necessary? It's because we can use appropriations with Treasury and federal agencies, but without ending the Fed, we can't truly influence the Fed. So safe to say it would be hard for me to be more opposed to this concept. I yield back.
The gentleman's time has expired, and I recognize the ranking member of the subcommittee, Mr. Lynch of Massachusetts, for 5 minutes.
Thank you, Mr. Chairman. First of all, I want to thank all of the witnesses for your willingness to help the committee with this work. This is a complex issue, so we appreciate your input. Mr. Carrillo, if we see what the private sector has done, especially with fintech and with just retail conduct in general, their method of operation is to vacuum up as much personal data as they possibly can, and they aggregate it, they track people, and then they sell it. If we were to allow the private sector, and that's what the suggestion of some of this legislation is, to push the government away and put this into the control of the private sector, would that be the type of digital currency or digital dollar that we want to protect the privacy of the American people?
Thank you very much, Representative Lynch. This question allows me to first clarify a point regarding Fourth Amendment doctrine, which I believe has been mischaracterized on this panel. The third-party doctrine creates problems precisely because of the connection between the private and public sectors. So to suggest that it is just going to not apply to the public sector and will apply to the private sector is to fundamentally misunderstand constitutional doctrine. We could have a system wherein private companies work with public companies, and that still could lend itself to mass surveillance. So these conclusory statements about application of the Fourth Amendment are not particularly helpful here. The laws and technology of the models being suggested do not lend themselves to the application of the Fourth Amendment. So I would urge more robust conversation around actual privacy law in these conversations. Now, I do not believe that either leaving the private sector in charge of financial service data collection or including it in an intermediated fashion in the CBDC context is going to improve privacy necessarily, and indeed is very unlikely not to do so. Thank you.
Thank you. As the ranking member of the full committee mentioned, there are already 130 countries out there representing 98% of the global economy that have already begun to explore and discuss, the idea around a central bank digital currency. Now, many of them are democracies. I'm not sure any of them have, well, with the exception of a couple, have made final decisions on how to deploy this or what the architecture will be. But is there value in at least looking at it and examining it? If the rest of the world is going in that direction, even if we don't want to do that ourselves and deploy it ourselves, isn't there value in exploring it? And we do a lot of research through DARPA that is it's a government agency. It works well with the private sector, and we explore possibilities. Then Congress rightfully makes that decision whether or not to deploy it. But isn't there value in that whole process in trying to understand the architecture and the implications of a digital currency?
Absolutely, Representative Litch. Thank you. I believe that that is sufficient reason alone, certainly, to explore the digital dollar. That said, I do also agree with you that the approach needs to be deeper and more expansive. We do not dedicate resources appropriately, and hardly at all in this country, to public money research and development. So in an instance, in this time, right now, we will have to partner between institutions in the public and private sector to develop the technology. Now, that is different from allowing private sector entities access to retail payments data under a digital dollar system, but we need an all-hands-on-deck approach to the building of both CBDC and electronic cash. And now, here I would make a special note that there are lots of stakeholders who are not represented, certainly in this hearing today, but otherwise, in other contexts, they're not represented as well. That certainly includes communities impacted by law enforcement, but beyond that, we're talking about small businesses and retailers that are raked over the coals by Visa and MasterCard with fees every day. We are talking about a wide swath of people who deserve privacy.
Thank you. My time has expired. I yield back.
I thank the gentleman from Massachusetts, and now we turn to Mr. Rose of Tennessee for 5 minutes.
Thank you, Chairman, and thank you to our witnesses for being here with us today. Dr. Michel, in recent years, we have seen many cases where the Fourth Amendment has been critical in protecting the rights of individuals. Cases like Carpenter versus the United States, which established that the government must obtain a warrant before obtaining cell phone location data, or Riley v. California, which held that the police must obtain a warrant before searching a suspect's cell phone. The law is developing in these areas to protect individuals' right to privacy, but it is still lagging behind in the financial sector. In particular, decisions in United States v. Miller and Maryland v. Smith gave us the third-party doctrine. Under that doctrine, if you voluntarily provide information to a third party, the Fourth Amendment does not preclude the government from accessing it without a warrant. Dr. Michel, can you explain how the third-party doctrine has impacted Americans' financial privacy?
Yes, they practically have none at the moment because of this, partly because of this, but I also want to clarify, because of something that was just said on the panel, the Fourth Amendment is, of course, that we're talking about is the one that amends the Constitution to the United States, which protects American citizens from the government. So, I mean, this is exactly the issue, and it was brought up in the cases in the 70s when the Bank Secrecy Act was challenged. If the Bank Secrecy Act were not there, the banks and financial institutions that we have would not be required by the government to collect the data that they are. That is a requirement in the Bank Secrecy Act. And that was always, you can go back, everybody can go back and look at those cases, that was always an issue as to whether this was constitutional and in violation of possibly the Fourth Amendment. So between the combination of the Bank Secrecy Act, the Fourth Amendment issues, and the third-party doctrine, Americans, although many of them don't realize it, have very little financial privacy at the moment.
How would the adoption of a CBDC further erode Americans' reasonable expectation of financial privacy?
I believe it would remove the last layer that we have, quite simply. Instead of having to go through the financial institution, the government would have that information either in a central database or a keystroke away.
And Dr. Michelle, your organization recently released a survey that found that 68% of Americans would oppose a CBDC if it allowed the federal government to monitor their spending. Why would the government want to monitor the spending of its citizens?
There is no way to implement a CBDC and provide all the benefits that the advocates say, including monetary policy effects, without doing that. That is the absolute key there.
The survey also found that 74% of Americans would oppose adopting a CBDC if it meant that the government could use the CBDC to control how people spend their money. Why would the federal government want to control what its citizens spend money on?
That's a great question. So aside from any political aspirations, that is the monetary policy piece of this.
Would they perhaps want us to stop purchasing guns or maybe gas-powered vehicles or gas stoves?
Politically, it is a nightmare for either side. It could be used to stop labor unions. It could be used to stop people from spending things on gas stoves. It could be used under any political guise as desired.
Stop them from traveling to a protest or expressing their First Amendment rights.
Which we've already seen in other countries without the CBDC. So I think this exacerbates all those political problems. That's exactly what this does, and that's exactly why we shouldn't have one.
What does the FDIC's annual survey among unbanked, Dr. Michelle, again, among unbanked households tell us about the value that some Americans place on financial privacy?
It tells me that a lot of them do place a very high value on it, and one of the reasons that some people stay out of the banking system is precisely because of that issue.
Proponents of a CBDC also advocate for Fed accounts and postal banking, yet a 2021 postal banking pilot program that was given $6 million and had only 6 customers and generated less than $35 in revenue. Could you discuss why postal banking would be a bad idea for the U.S. economy?
Well, it's a bad idea for the same reasons that we've discussed with as general a CBDC or a digital dollar backed by the U.S. government, and it also highlights that the private sector in the United States actually does do a good job of providing financial services in general, broadly speaking.
Thank you. I yield back.
Now it's a pleasure to turn to the gentleman from Illinois, my friend Mr. Foster, for 5 minutes.
Try this one. All right. And we're in business. Okay. Let's see. Now I've lost my cheat sheet here. Okay. First, just in the issue of sort of the foundational issue of privacy, how many of the witnesses feel that the current, Bank Secrecy Act, the KYC, AML, SARS, and although that it represents a violation of the Fourth Amendment and should not be a feature of future payment systems? How many believe? We have the first witness indicated. Everyone else believes that for future payment systems, there should be some form of KYC, AML, and so on. The traceability of transactions. Okay, that's an interesting sort of branch point of this discussion. Because then the question is, how do you implement the best policy, the best privacy? Mr. Carrillo, you referred to the privacy preserving design for this. Is there a specific implementation of that's ever been carried out or even designed? I presume this involves some sort of official government action to de-anonymize transactions or something like this. How does this, can you say a little more about how that might work?
Yes, thank you, Representative Foster. I appreciate the opportunity to provide more details and to clarify the vision of electronic cash, especially as it pertains to the eCash Act. We envision hardware devices, so those can be cards similar in size to an existing debit or credit card, or they can be secured SIM cards or something like it on a phone that would enable hardware-based transactions and for people to make payments as they do today with paper cash for everyday things without fear of government or corporate surveillance, which occurs in tandem when we use digital payments today. As for the security question, yes, the hardware will be encrypted, certainly, but there are security controls that can be enabled to implement AML KYC at the technological level. Currently, BSA AML treats different types of technology differently. They have each of their sub-legal regimes, and so the regime that applies to cash and currency would in fact apply to the eCash.
Okay, if you could sort of provide, for the record, some documentation on how that actually might work. I've got a bunch of technological questions like, the degree of trust you have to place in the hardware implementation of your eCash. If it's blockchain-based, double spending problem and operation offline.
I would be happy to do so, Representative Foster. I would clarify that the point of eCash is that it does not operate online. It is actually open, permissionless, and private in the sense that you don't need a blockchain or a banking intermediary. Moreover, I would point that I think it's incredibly important to engage with universities on this issue. They've been left out of the technology and industrial policy conversation that's occurred here today. Universities are a great site of research that we can get where there is not a pernicious, lucrative interest involved. Certainly, universities gain from these partnerships, but they need to play a stronger role moving forward.
Okay. Maybe I'll poke again at the privacy question with a specific example. Let's say someone puts a gun to your head, drags you into an alley, says, get out your phone, transfer all of your eCash or whatever to me, or your crypto assets to my phone or some other device they have. Then is it your view of the endpoint of privacy that we have a duty to preserve the privacy of that criminal or not? Or should there be a backdoor on figuring out who the heck owns the account or device that it was transferred into?
Thank you, Representative Foster.
Yeah, well, could I start with our second witness, Ms. Paradan?
Sure. No, I think there should be a record of the
There should be
ability
a
to track.
traceable record so that you can, or for ransomware, for example, when someone says, I've encrypted your files.
That's my personal view, yes.
That's your personal view?
Yes.
Dr. Michael?
Well, you don't have that for anybody who uses ransomware now,
your
but
answer
you
is
still
that it's
find
okay.
them.
Yeah, your answer
No,
is
I think you should be able to have a private transaction without AML. That's absolutely correct, yes.
okay. So that you're in favor of the ransomware, basically, that we should not.
I did not say that, and I hope the record reflects that.
Okay, no, I understand. But the system that allows ransomware to exist is something that you're in favor of preserving.
No, ransomware exists whether the system allows it or not.
The payment system for ransomware
Does not allow ransomware to exist, sir.
Okay, well, Jinja, oops, I'm running out of time here, but I thank the chairman for having this hearing.
Dr. Foster, thank you very much. We now turn to the gentleman from Wisconsin, Brian Stile, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you for holding today's hearing. This is a really important topic. CDBC gives me significant concern as it relates to Americans' privacy. We've seen our privacy invaded in a number of ways. I think a federal government CDBC would be a worse situation. In particular, I don't think the Federal Reserve has the authority to do a CBDC. I think that's important to note. I don't think Congress should give the Federal Reserve authority to do the CBDC. And the reason is based on the federal government having access into that level of information about American citizens. And I think some of the distinction from the previous question as it relates to the ability to track this is whether or not that information is in a depository of your federal government or if that's in records in the private business sector. And I think it's important that we pull this distinction apart. If I can, let me shift gears slightly, though, and come over as it relates to liquidity in the market. In Ms. Paradon, in your testimony, you wrote any transfer of a dollar deposit from a commercial bank or credit union to a CDBC is a dollar unavailable for lending to businesses or consumers. Can you expand a little bit on that statement about how an adoption of an intermediated CBDC how would it impact credit and availability and the cost of banking services?
Sure, happy to, thank you. So I think there's a misconception generally that a dollar transferred from a deposit account to a CBDC that CBDC would still be able to be used for lending and investment in the economy the way that dollar deposits currently are now. And that is not the case. A CBDC, even if intermediated, in other words, even if the services, including onboarding and other services that commercial banks currently provide, even if those services were provided by banks with respect to a consumer's CBDC, the fact is the bank would really only hold that CBDC in the same manner it holds an asset in custody. So it would have to essentially keep that CBDC under the proverbial mattress, and it would not be able to be redeployed in the form of loans.
So thank you very much. So let me build on this if I can, Mr. Michel. In particular, how that would impact monetary policy, if you take what Ms. Paradon just said.
Well, it would have a large impact in the sense that it would be very different from what we're doing now. You would have where we have a predominantly privately provided system of money or amount of money. You would no longer be doing that, or until you get there, you would be raising the cost of doing so in presumably some other method. Not the traditional banking sector through intermediation process that we have now. And what everybody has to understand is that this would allow the government to put money directly into accounts as well as take it out. And nobody ever wants to talk about that one. When things are going, and ironically, when things are going bad and a recession's coming, that's when you would see the Fed want to go toward negative interest rates, and everybody would stop and say, wait, what are we doing? And the only way to do that is to provide zero options for anybody to use any other payment method. So to get all of those benefits, you have to, at some point, make this the only option, not just another option.
Let me shift gears with you, Mr. Michel, because I know you didn't have enough time to respond to this on the privacy question. Does your privacy concerns have to do with the CBDC being government-controlled rather than private sector-controlled?
Yes, that's correct.
And so how does that play out? So as we think about maybe like China going forward with the CBDC, having none of the constitutional privacy rights of an American citizen, and if we think about that from the government standpoint versus an American private sector standpoint, how should policymakers think of that?
Well, I'm of the view that of the private sector, you have many different companies doing many different things, and if people decide that they're not doing something that they like, there is a remedy for that. There's always a remedy for that. Whereas if you have the government dictating what can and cannot be done, then that's the only one thing that can be done, which is why we have the Fourth Amendment in the first place.
I think that's a really important distinction here. The CBDC puts the power in the hands of the federal government rather than in the hands of the private sector.
Correct.
I think there's a major distinction between American capitalism and a government-centric approach that we'd also see in China. I thank the chairman for having today's hearing. I yield back.
Gentleman yields. Gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Mr. Hill, and thank you to the committee for having this hearing and for the couple years now we've spent on this issue. I want to focus on some pretty just high-level basic issues because I feel like we're having conversations about theory that are disconnected from facts. And I want to start, and I don't want to sound cutesy, but I just want to start with something real simple. Remember the scene in It's a Wonderful Life when George Bailey walks through, the money's not here, it's in your house, in your house. Were any of you confused by that scene? Okay, let me back up. As best as I can tell, about the 12th century, the Knights Templar essentially invented fractional banking. It was this fascinating history. It was part of the Crusades that you could put your money in a bank in London, and there was script that went through all the way to Jerusalem, and you could get through, and they were loaning against deposits. Does anybody find the basic principle of fractional banking confusing? Okay, all of you are smarter than 90% of the world's crypto bros. Thank you, because sometimes this conversation is maddening to me because it's predicated on the idea that like the value of money is just the amount of hard currency in circulation. Now, I ask those questions, and Ms. Paradine, I really appreciated your comment because I think if I understood your testimony, you said that CBDCs always have to be liabilities of the issuing central bank, correct?
That's how it's been defined,
Yeah.
yes.
Okay, and by the way, Lael Brainerd testified to the same effect about a year ago here. That means that banks can't lend against deposits, which means, if I understand right, that a CBDC can only grow M1 money supply. Would you agree with that?
Well, a CBDC, if it was in an intermediated CBDC, banks would essentially hold CBDC as a custodian. That's right. They wouldn't be able to lend out some portion of the CBDC as they do deposits.
Yeah, so it essentially, it upends what the Knights Templar came up with in the 12th century. It's only M1 money supply.
Correct.
Right? So isn't it also then true that to the degree that any central government, our central government, the Chinese central government, the Vietnamese, I don't care, any central government that increases the relative share of their M1 money supply, that is CBDCs as opposed to traditional currency, aren't they de facto shrinking the size of their economy because there's simply less money in circulation? Because as that ratio, if you had 100% CBDCs was all the M1 money supply, you'd have no lending, right? So doesn't any proportional increase in the amount of CBDC in an economy shrink the economy?
Well, there's there could be shifts to other forms of ways to fund lending. Banks could borrow in the wholesale markets. They could potentially borrow from the Federal Reserve. So I'm not necessarily sure it's a one-to-one relationship as you.
Well, but what I'm saying is like central banks are issuing currency into the economy, right?
Correct.
And all of the other forms of currency they introduce are leverageable. This is
Right.
We seem to be in agreement that CBDCs by definition are not leverageable.
A retail CBDC, that's right.
Okay, so I'm left like, why do we care? Like, we can talk about all the theory of all the things that, if I had a unicorn that could fly, I'd have a shorter commute to work. But if we can't make the case that this actually makes sense for modern banking, and by modern I mean banking as it has existed since the 12th century, and if our competitors, if the answer is, well, if we don't do it, the Chinese will, sounds to me like, have at it.
We are not supportive of a retail CBDC, so I would tend to agree with you. And I think there are reasons that people believe a CBDC could be beneficial. To date, we don't think that there's necessarily evidence to support those benefits. For example, we don't believe it would increase financial inclusion. We don't believe it's necessary to increase the speed or efficiency of payments, but there are, those who do believe it has some purported benefits.
Well, I guess, look, we've been having these conversations for 2 years because there is a sex appeal to the digital currency space, and that's true for stablecoins, it's true for Bitcoin, and time will tell whether this is sexy in the way that the advent of the internet was sexy or sexy in the way that Beanie Babies were sexy. But somebody has to make the case for this actually being useful for currency and not just for money laundering and not just for speculative bubbles before I think we have something to worry about. I yield back. Thank you.
I thank the gentleman for yielding back, and now the gentleman from Nebraska, the home of the FinTech flyover. The gentleman, Mr. Flood's recognized for 5 minutes.
Thank you, Mr. Chairman. The gentleman from Little Rock was a keynote at the FinTech flyover and much appreciated. Let me begin by making something evidently clear. I am firmly opposed to a retail CDBC. My opposition to a retail CBDC comes down to one simple concern at the heart of our republic, which is concentration of power in the hands of the federal government. A CBDC issued by the Federal Reserve would open the door to a few different troubling potential futures, regardless of the intent of the original issuer. If we use a retail CBDC, the Federal Reserve would be at the center of every American transaction. It could be used to prevent certain types of disfavored purchases, block certain disfavored people from using our financial system, or monitor the payment activities of political opponents. That's an enormous amount of power, and that power would put tremendous pressure on the Federal Reserve. My concern is that once we build a CBDC, we don't have it just today and tomorrow with our current set of regulators. A retail CBDC would be a serious threat to liberty, even if our current leaders were angels. Once rolled out, a CBDC would ensure well past the time of anyone in this room. It would endure well past the time of anyone in this room. It will continue to be influenced and changed by future leaders over the coming decades. Some proponents of this may point to concerns over practices regarding how some private companies collect consumer financial data. They may argue that it's better to put the payments process under the oversight of the government directly than have private actors in charge. Such an argument doesn't fully contemplate the extent of the possible abuse that could come from regulators or political actors if given this tool, and that's a point I'd like to dig into a bit more in my questions. Ms. Skinner, in your testimony, you mentioned how a CBDC could lead to the Federal Reserve's independence being threatened. Can you speak more on that?
Yes, certainly. Thank you for the question. So in the first instance, to the extent the Federal Reserve doesn't change the composition of its balance sheet otherwise, issuing a CBDC will increase its liabilities, which means that it has to match that increase in liabilities by purchasing more assets. So the first thing that we would think about when the Fed would purchase more assets would be buying more Treasury securities. That being said, with the potential for the Fed to issue more CBDC, thereby giving it more headroom to buy more Treasury securities, would be likely to put some pressure on the Fed at some point down the line from the Treasury to issue that CBDC to absorb more government debt, which we call monetary finance or monetizing the deficit. And before World War II, the Fed essentially operated under the thumb of the Treasury so that during wartime and otherwise, the Fed could effectively monetize the deficit. And really today, that's anathema to an independent central bank. There are other things that the Fed could also be pressured to buy to match an increase in CBDC, like corporate bonds. Now, our recent experimentation in corporate bonds has put some question around whether this too could politicize a central bank, because inevitably, if central banks buy corporate bonds, they're picking winners and losers in the economy. Now, the Fed has been pretty neutral in its approach, but there has been a lot of pressure on the central bank to, for example, buy green bonds in order to facilitate a transition to a low carbon economy, and certainly other central banks do actively green their corporate bond portfolios.
And I appreciate that, and you have a great answer there. I want to get to one more question with Dr. Michelle. Doctor, you spoke in your testimony about the potential for a CBDC to be programmed for specific purposes and even used to achieve monetary or fiscal policy goals. Can you elaborate on why that might be a potential problem?
Well, it's a potential problem in the sense that for these potential benefits to be recognized, you have to do it that way. It is a completely programmable device. If you are, for example, in the middle of a pandemic, you would be able to flood the market with money, and at some point you have to take that money out of the market. As soon as you're doing that as a central bank, you have to decide exactly who to give it to and exactly who to give it away or take it away from. That's a political nightmare. Frankly, I don't think the Fed wants anything to do with, and I'm positive most Americans don't want the government to have to make those decisions in that way.
Really appreciate that answer. And you know, I'm not one to engage in alarmism, but some of the things we've discussed today are serious possibilities that must be considered both within the context of today and the possibilities of how these risks could evolve in the future. With that, Mr. Chairman, I yield back.
I thank the gentleman. I'd like to inform our panel we are going to recess. We have a few more questions after we vote. There are 2 votes. This is the first one. There'll be one more, which will be shorter. Thank you for indulgence, and the committee stands in recess till after votes. Hey, panel, I'm giving you a warning that we're getting ready to start. Everybody put everything hidden, all the drinking, all the mixed drinks under the table. Are we ready? We're going to start with Mr. Timmons as a courtesy because we have a gentleman who needs to get on. We are returning to our hearing. We thank our panel for their patience. And we now turn to Mr. Timmons. He's recognized for 5 minutes.
Thank you, Mr. Chairman. Throughout this hearing, it's become clear to me that CBDCs pose considerable risks that cannot likely be offset by the benefits they purport to bring to the United States payment system. Indeed, from my vantage point, a proposed U.S. CBDC is a solution in search of a problem. This reality is magnified by the fact that the U.S. payment system is already being modernized both through private sector developments like stablecoins and through public sector improvements to existing payments infrastructure. The significant privacy and civil liberties concerns associated with CBDCs, as the witnesses have discussed here today, would be mitigated in the private sector through well-regulated stablecoins or other payment innovations. Yesterday, we had a hearing with CFIUS where we discussed cybersecurity challenges facing the national security of the United States. Along those lines, Dr. Michel, what cybersecurity risks are associated with CBDCs, and are these risks apparent in the private sector?
So I believe this is a question of centralization versus decentralization, and if you have a CBDC, you ultimately have one major point of failure. The Fed, presumably one way of doing this, or not presumably, one way of doing this would be to have the Fed have a database. Well, we know the Fed's been hacked. Even if the Fed has multiple databases, it's the Fed being hacked, as opposed to having multiple private companies all across the country. If Capital One, for example, has a hack or a cybersecurity problem, everybody in the country is not immediately at risk, only their customers, and that's a problem for them.
You're going in the direction I was going to go. At the end of the day, best practice for large private companies is to have cybersecurity insurance. You have a breach, and you do your best to mitigate it. A breach is inevitable, and you know that, so you insure against it, and then you take steps to address the breach, and then you get sued, and you pay the individuals that you damaged money because you did them wrong. That's just our legal system. So I want to point out that the CFPB had 250,000 of their files leaked in what was the most preventable breach I've ever read about. And the people that were damaged, the citizens that were damaged, that had their personally identifiable information used to do a wide variety of schemes to generate money from the hackers, they don't have any recourse. There's no recourse. So not only is this public option bad for a wide variety of reasons, but in the event of a breach, which again is pretty much inevitable, there's no recourse to make the individuals whole. So I think that's something that we need to think about. The government's not good at this stuff, and they're not good at making people whole when they make mistakes. So just wanted to throw that out there. Following up on this comparison between the benefits that a CBDC could bring versus the benefits a private sector stablecoin could bring. Dr. Michel, again, I see you've worked to push back at the promises made by proponents of CBDCs. Based on your research, can you explain what, if any, technological advantage a CBDC has over the private sector?
None, and this is properly viewed as a government reaction to a private innovation. You could call it Bitcoin, or you could just call it distributed ledger technology in general. That's what this is about. This is about the government seeing an innovation that possibly threatens their control over the payment system, and it is a movement to come up with something that takes that back. And it just so happens that what they're coming up with here is something that goes even further than where we are without the CBDC. So it is about control.
These are the same people that tried to require mandatory reporting for transactions over $500 to pay for their pipe dream bills that they were trying to push through. Switching gears somewhat, Professor Skinner, we held a hearing on CBDCs last year. I asked former Federal Reserve Vice Chair Lael Brainerd, what can be done to strengthen the dollar's status as the world reserve currency? Is a CBDC something that would strengthen that status, or would it weaken it?
Thank you for the question. It certainly, in my opinion, would not strengthen the dollar's status, and it could potentially weaken it for the following reasons. As I mentioned in my opening remarks, the status of the dollar is undergirded by our commitment to the rule of law, democratic institutions, having a judiciary that enforces property rights, and perhaps most importantly, maintaining the dollar as a stable store of value. So for there, it's important that the Fed maintain its fight against inflation. And with the issuance of the CBDC, there will absolutely be a propensity to over-issue, to, for example, monetize the deficit. And if that were to happen, that would undermine the status of the dollar.
Thank you. Mr. Chairman, I yield back.
I thank the gentleman. Now we recognize the gentleman from North Carolina, Mr. Nickel, for 5 minutes.
Thank you, Mr. Chairman. As a co-sponsor of Subcommittee Chairman French Hill and Jake Auchincloss's Power of the Mint Act, I believe only Congress has the power to authorize a central bank digital currency, or CBDC. The Constitution is very clear about this. Article 1, Section 8 states that only Congress has the authority to coin money. So this shouldn't be a partisan issue. And much of the work that we've done at the committee level and certainly at the subcommittee level here has been bipartisan, and I want to acknowledge that Chairman Hill's approach on these issues. We've been very involved in a lot of these, and that continues with this issue as well. CBDCs do have the potential to be an important innovation. They could enhance financial inclusion, reduce transaction costs, and increase the efficiency of our monetary policy. The Atlantic Council estimates that 130 countries are currently exploring a CBDC. We should too. The United States must remain the global financial leader, especially with the dollar's role as the global reserve currency. We can't afford to fall behind or lose our global influence. On the other hand, we must approach this innovation cautiously, especially in light of the Chinese Communist Party's use of its CBDC. I have concerns surrounding privacy and surveillance, which is why we need to continue studying this issue. The Chinese Communist Party model raises red flags about the potential for governments to exert unprecedented control over their citizens' financial lives. As representatives of a democratic nation, we need to be steadfast in safeguarding the privacy of our citizens. As we deliberate on this crucial issue, let's remember that our ultimate goal is to create a financial system that empowers all Americans while preserving the values that make our nations great. Now, thank you again to the witnesses for being here. First question, Ms. Paradon. One of my concerns with CBDCs is that they could impact the availability of credit for my constituents, especially during economic stress because of a reduction in bank deposits. How do you view this concern?
Yes, we share that concern. A so-called flight to quality is something that we fear would be almost inevitable were a retail CBDC to be issued by the Federal Reserve. In times particularly of financial stress or instability, a CBDC would be viewed likely as the ultimate safe asset, and depositors would likely be incentivized to pull their deposits out of the banking system and put them into CBDCs as a safe asset, which would reduce the availability of deposits available to lend out and moreover increase the cost of credit.
Thank you. Mr. Carrillo, to you, given the US dollar's role as the world's reserve currency, why is it important for us to join the 130 countries studying CBDCs?
Thank you very much for the question, Representative. I appreciate it. I think that the United States has not only the privilege and the freedom, but the responsibility to lead on this issue and to especially make sure that civil rights are incorporated into the next system. I believe we can do that. I believe that we have the innovation capabilities, and together working together, entities in the public sector, in the private sector in terms of procurement and operations, and in our research institutions, we can all move forward together. There are many examples of having done so before. President Lincoln created cash after the Civil War in order to help everybody have day-to-day transactions throughout our economy. Today, we have cutting-edge technology in various other sectors in the government, including in the U.S. military, where they use stored value cards known as Eagle Cash in order to make offline payments.
Thank you, Mr. Chairman. I yield back.
I thank the gentleman for his questions. And now I turn to Ms. Houchin for 5 minutes.
Thank you, Chairman Hill, Ranking Member Lynch. Thank you to the panelists today for providing your testimony and speaking with us today. When I talk with my constituents back home about financial technology and crypto issues, a common concern that I hear is about the possibility of a central bank digital currency, or CBDC. From privacy issues to the threat of debanking political enemies, people back home have told me that government surveillance and the total control that is threatened over their wallets is too great a threat to balance against any of the proposed benefits a CBDC would bring. Mr. Roos, we have all heard the stories of China utilizing its CBDC to surveil its own citizens. Obviously, the United States is a completely different country than China, but if the United States were to issue a CBDC, in your view, what would be needed to ensure that it wouldn't resemble something like China?
Thank you for the question. I think that it's important for this hearing, first of all, to state that most of the concerns that have been discussed in this hearing are related to retail CBDC, meaning CBDC that is issued directly to citizens. And in that case, as I stated in my opening remarks, any digital representation of the US dollar should benefit from the privacy and trust, as stated in the Fourth Amendment. So I think that first of all, I think it's important to make that distinction. Second of all, if the US government were to decide to issue a retail CBDC, unlike wholesale CBDC, I think that it is going to be critical for the government to show and evidence that there is no ability for the government to see transactions of citizens. I personally would be against such an act.
Thank you. And when speaking about CBDCs, the threat of debanking, that certainly comes up almost universally, especially when talking to gun manufacturers and such in my district. Operation Choke Point under the Obama administration, we saw instances where Americans who were involved in what political opponents determined to be undesirable industries, like gun manufacturers, would be cut off from bank accounts or unjustly severed from lines of credit simply due to the businesses that they're in. With a CBDC, not only could the federal government tell banks and other financial institutions what services they can or cannot provide to different businesses, they would be able to track potentially every dollar that's in someone's wallet, where it goes, and what it's used for. Mr. Roos, in your testimony, you emphasized that Digital Asset built its products and services with privacy as its core. Would you be able to walk us through a transaction that occurs using Digital Asset's products and explain how privacy is preserved throughout the life cycle of that transaction?
Sure, thank you for the question. When we design our product, the product itself allows the issuer of any asset to determine who has the rights to look into a transaction. So in the case we're talking about here, if we wanted to have privacy included in the smart contract of the money, it would state that any movement of money would only be visible to the sender of money and the receiver of money, for example, and the issuer of money would be blinded. So all that the issuer would see is the overall balance, but would not see any underlying movements of the money, for example.
Okay, thank you. You also stated that Digital Asset is seeking to modernize financial infrastructure using blockchain technology. While this goal seems to be aligned with what wholesale CBDCs are seeking to accomplish, it appears a far cry from what retail CBDC purports to do. Is that a fair assessment of Digital Asset?
Yes.
In your view, is it a mischaracterization to discuss the modernization of the United States back-end financial infrastructure as a wholesale CBDC?
As long as we're talking about modernizing FedWire or FedNow in order to eradicate reconciliation, the answer would be yes. Again, if it's to introduce central bank digital money directly to retail customers, then the answer would be no.
Okay, thank you. As my colleagues and you on the panel have highlighted, the negative consequences are pretty great. And the recent stablecoin legislation that we passed out of this committee will establish guidelines and safeguards and a clear path forward for a private sector solution that brings all the benefits of blockchain without any of the privacy or politicization concerns of a government-controlled CBDC. It's my hope we can work together to see that this bill becomes law to create economic opportunities and innovation across the country without putting constituents' privacy or financial well-being at risk. Thank you, Mr. Chairman. I yield back.
Thank you, gentlewoman. And now the gentleman from California, Mr. Sherman, is recognized for 5 minutes.
I joined the last speaker and colleague in a concern about Operation Choke Point. I know there were some on the Democratic side who said, yes, go after payday, go after gun manufacturers. How will that sound when Planned Parenthood can't get a bank account? The power to take somebody out of the banking system is the power to impair, if not destroy them. We currently have a balance between privacy on the one hand and law enforcement on the other, and I'd like to keep that balance pretty much the same. That's why I oppose a cryptocurrency ecosystem in which millions of dollars can go from one unnamed entity or person to another unnamed person, and there's absolutely no way for law enforcement to ever know who was on either side of that transaction. On the other hand, I want to maintain the current balance. I don't necessarily want the Fed to see every transaction. We have a system now where suspicious transactions are reported to law enforcement. We already have a digital dollar. I can go several days without touching a green piece of paper with a picture of a dead president on it. And I'm still waiting for those Tubmans, but I think by the time we get them, we may not use them. The question, and look, we need a much better digital dollar. It's still too expensive, too cumbersome to be able to pay money one way or the other. But I think we'll get there with or without the Fed. As to the Fed, let's point out that the Fed is really bad at retail. We have an ACH system which they administer, and it's so problematic that when I bought a house, every single note I got from the escrow agent in flaming letters, I couldn't read anything else. Don't trust any email you get as to where to wire the funds. Why? Because in spite of a lot of questioning I've done in this room, the Fed has refused to follow Britain's lead and have a payee maxing system. So if you can convince a new home buyer to send their money to account 12345, it never reaches the escrow company. It goes to a Nigerian prince. And they don't even have to pretend to be they don't even have to open an account in the name of the escrow company. I can imagine how the Fed would deal with millions of different accounts. But we already have a system, unfortunately, where you can open an account at a bank without ever showing up in person. All you need to do to steal my paycheck is to steal my paycheck and my driver's license and maybe a cable television bill. Then you open up an account in my name, you flash my driver's license, the fact that your picture doesn't look anything like me, in which case be thankful, doesn't prevent you from opening up an account in my name. So I would like to see a system where human beings have to talk to another human being to open up an account that's in their name, and I can't imagine that Jay Powell is going to be any part of something that is that retail. But I join with others on this concern, and I have a question for Mr. Cabrillo. I'm concerned about the effect this is going to have on deposits at regional banks and credit unions and smaller banks. We tend to focus on the financial system, but we need to see local business loans made. And Uncle Jay Powell is not going to loan money to my local pizzeria. what effect do you think this is going to have on the ability of local businesses in my district to borrow money?
I believe the question is directed at me, is that correct?
Yes.
Thank you very much, Representative. I appreciate it. So I would say that our deposit insurance structure, our system of how we handle deposits legally right now is actually quite broken. And I would welcome revisitation of that post the Silicon Valley bank crisis. I think we are looking at a situation where we need to clarify, streamline, and bolster the deposit insurance and protection structure. And in fact, digital fiat currency provides us with an opportunity to do so. I would say that further federal government control of the deposit system should actually be welcome in the sense that it provides stability and also allows and creates space for commercial banks to engage in credit creation and maturity transformation, which should be the actual goal of banking.
Thank you.
Gentleman yields back. I'd like to thank our witnesses and our members on both sides of the aisle for their participation in this hearing. Thank you for your testimony today. Without objection, I'd like to enter the following documents into the record. My letter to the Attorney General from last Congress on the Department's assessment of whether legislative changes would be necessary to issue a CBDC, and the follow-up letter that Republicans sent in March of 2023, and including in the record letters from the American Bankers Association, the Electronic Transaction Association, Independent Community Bankers of America, and the Credit Union National Association. Without objection, they are included in the record. Thank my colleagues on both sides of the aisle. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as you are able. This hearing is adjourned.